Most people avoid the stock market their entire lives, not because they're bad with money, but because nobody ever explained it to them properly. Today that changes. By the end of this video, you will understand exactly how the stock market works, from the ground up. No jargon, no complexity, just the truth about how it works and how ordinary people use it to build real wealth. Before we talk about the stock market, we need to talk about companies. Every business starts small. A founder has an idea. They build something, it grows. But growth costs money. You need more staff, more equipment, more locations, more everything. So where do you get the money to grow? Option 1, borrow it from a bank. Take a loan. Pay interest every month. Option 2, find investors. Bring in partners who give you money in exchange for a share of the business. That second option, at a massive scale, is exactly what the stock market is. When a company decides to raise money from the public, they divide the company into millions of tiny equal pieces. Those pieces are called shares, or stocks. Think of it like a pizza. If the whole company is one pizza, a share is one slice. The company sells those slices to the public through a process called an IPO, an initial public offering. And suddenly, anyone with a brokerage account can own a piece of a real business, a piece of Apple, a piece of Amazon, a piece of Tesla. You become a part owner, a shareholder. So what does it actually mean to own a share? It means two things. First, you own a proportional piece of everything that company has. Its buildings, its cash, its future earnings. Second, if the company grows and becomes more valuable, your share becomes more valuable too. If you buy a share of a company at $100 and the company doubles in size, your share is now worth $200. You didn't do any work. The company grew, and you grew with it. That's the power of ownership, but it works both ways. If the company shrinks, your share loses value too. Ownership means sharing in both the wins and the losses. Now, where does all this buying and selling actually happen? On a stock exchange. The two biggest in the world are the New York Stock Exchange, founded in 1792, and the Nasdaq. Think of a stock exchange exactly like a marketplace. But instead of stalls selling fruit and vegetables, the stalls are selling ownership in companies. Thousands of companies are listed on these exchanges. And every single day, Monday to Friday, buyers and sellers come together to trade shares. In the past, this happened on a physical trading floor with people shouting and waving papers. Today, it happens digitally in milliseconds, through computers and brokerage apps on your phone. This is the part most people find confusing. How does a share price actually get set? Here's the simple truth. A share price is just the last price that a buyer and a seller agreed on. Nothing more complicated than that. At any given moment, some investors think a company's stock is cheap and want to buy. Others think it's expensive and want to sell. When a buyer and seller agree on a price, the trade happens. That price becomes the current market price. And then the process starts again, immediately, thousands of times per second. The price you see on your screen is simply the most recent price that two people agreed was fair. So what makes prices go up and down? The same thing that makes every price in every market go up and down. Supply and demand. When more people want to buy a stock than sell it, the price goes up. Buyers compete with each other. They offer more. Price rises. When more people want to sell than buy, the price goes down. Sellers compete with each other. They accept less. Price falls. It's that simple. What drives that buying and selling pressure? News about the company, earnings reports, economic data, investor sentiment, sometimes even just rumors and emotions. The market is a voting machine in the short term, reflecting how people feel. But in the long term, it's a weighing machine, reflecting actual company value. You've probably heard the terms bull market and bear market. A bull market is when stock prices are generally rising over a sustained period. Investor confidence is high, the economy is growing, people are buying. A bear market is when stock prices fall 20% or more from their recent highs. Fear takes over, people sell, prices drop further. Here's what's important to understand. Both are completely normal. Both are temporary. Every bear market in history has eventually been followed by a bull market. Every single one. The bear market is not the end. It's a sale. Now let's address the biggest myth about the stock market, that it's gambling, that it's a casino. It is not. In a casino, the house has a mathematical edge. Over time, the casino always wins, the player always loses. The stock market is structurally different. When you invest in the stock market, you are buying ownership in real businesses, businesses that have employees, products, revenue, customers. As long as the economy grows, which it has done consistently for over 200 years, those businesses grow in value. And as a shareholder, you grow with them. The stock market has returned an average of 10% per year over the last 100 years, through wars, through recessions, through pandemics, through crashes, 10% average, every year, over a century. No casino gives you those odds. But what about crashes? The 2008 financial crisis, the 2020 COVID crash, the dot-com bubble. These were real. They were painful. People lost enormous amounts of money. But here's the critical detail. The people who lost money permanently were the ones who sold. If you owned a diversified portfolio in 2008 and you panicked and sold, you locked in your losses. The market recovered. You didn't recover with it. If you held, if you did nothing, your portfolio recovered fully within a few years. And if you were brave enough to buy more during the crash, you came out significantly ahead. Every crash in history has looked terrifying in the moment. Every single one has recovered. Patience is the most valuable investing skill you can develop. So how does an ordinary person invest in the stock market without becoming a professional analyst? The answer is index funds. An index fund is a single investment that automatically owns a small piece of every major company in the market. When you buy one share of an S&P 500 index fund, you own a tiny piece of the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them, automatically. No stock picking, no research, no expertise required. Your investment rises and falls with the overall market. And since the overall market has gone up consistently for 100 years, your investment goes up too. Index funds are how Warren Buffett recommends ordinary people invest. They are low cost, low maintenance, and historically highly effective. Here's where it gets exciting. The real wealth-building power of the stock market isn't just the 10% average annual return. It's compound interest. Compound interest means your returns earn returns. Year 1, you invest $1,000. It grows 10%. You now have $1,100. Year 2, that $1,100 grows 10%. You now have $1,210. You didn't add any money. The growth grew. Over decades, this becomes extraordinary. $200 a month invested from age 25 at the historical 10% average becomes over $1 million by age 65. Not because you invested $1 million, because you gave time enough space to work. Time is the most powerful variable in investing, not the amount, time. So how do you actually start? Step 1, open a brokerage account. Platforms like Fidelity, Vanguard, or Charles Schwab in the US, or whichever regulated platform is available in your country. Step 2, start with an index fund. Look for an S&P 500 index fund or a total market fund. Low expense ratio, under 0.2%. Step 3, invest consistently. Set up an automatic monthly contribution, even $50, even $100. Step 4, don't touch it. Don't check it every day. Don't panic when it drops. Don't celebrate too hard when it rises. Just let time do the work. That's the entire strategy. It's boring. It's simple, and it works. Before we finish, 3 common mistakes to avoid. Mistake 1, trying to time the market. Buying and selling based on predictions. Even professional fund managers fail at this consistently. Mistake 2, putting all your money in one stock. Diversification protects you. Index funds diversify automatically. Mistake 3, checking your portfolio every day. The stock market fluctuates constantly. Daily checking leads to emotional decisions. Check quarterly at most. The stock market is not complicated. It is not a casino. It is not just for rich people. It is a system that allows ordinary people to own pieces of extraordinary businesses. And over time, as those businesses grow, to grow with them. You don't need to be an expert. You don't need a financial advisor. You need an index fund, a monthly contribution, and patience. That's how ordinary people build extraordinary wealth. Start today.